Hey everybody, it's the Market Sniper. Welcome back. Glad to be with you. Hit a like, bang the subscribe. Remember to hit the bell and say always notify. What we're going to talk about today. We're going to talk about the CPI that came in. That's right. The consumer price index prices did show their face. They did indeed, sir. 3 bags full. And what did they say? Well, let's get it straight from Forex Factory. But it's safe to say the numbers came in under what was anticipated. So go to forexfactory.com. It's who I use. USD CPI month on month expected 0.3, which points to 0.3 times 12. People do the Chinese mathematics, projecting out. Came in at 0.1, which is a miss, and it's an undershoot, hence why it's in red. So we're looking up top here, so bear with me. Expected number. Oh, we've got to go back to TG Pink. That's a bit dark. Expected number was 0.3 and got in was 0.1. Then the CPI for the year 7.3 was expected. Previous was 7.7. It came in at 7.1, an undershoot as well. This is already the demand destruction that is being affected by the interest rates hike so far. So not only was the Fed shockingly late and in denial about inflation, when they finally woke up that they had to get serious, remember they did that 0.25, the first rate hike, when we were expecting Bitcoin and gold both to go down, and they actually ended up going up, saying, they're not serious. Well, they suddenly woke up the following rate cycle and did 4 in a row, 0.75 interest rates hikes. That has been one of the fastest, most brutal tightening cycles. What happened to the core CPI? It also came in a little bit below. So overall, it was an undershoot on everything. That is inherently, in terms of interest rates, dollar weakening, because it means the rate rise that is meant to come tomorrow, that we'll see where it is going to be lower than expected. But remember, we're only at 4 and this is still above 7. So you're only really reining in inflation when your rates are actually higher than the inflation rate, and not just the same or close to. They need to be higher and some a wee bit, and that's not happening. So at the moment, we are still only just doing sufficient demand killing to take some of the fluff out of the inflation rate. So what should that have done? Well, it should have weakened the dollar, and you would have seen that. And what actually happened in equities? So let's pivot over to what we're going to talk about. And I'm going to go and stick my neck out and call a localized high here, is that the equities pumped all day. Yay, there's going to be a smaller pressure and reduced pressure on interest rates to come in higher. And there's an interest rate meeting tomorrow. So as a result, good for the market. Rates are not going to go up as much as we might have expected. As a result, we can buy the stocks. Well, they did for most of the day. And then after getting to the end of halfway through the day, they suddenly thought, hold on a minute. This could mean that the demand is actually constricting. Earnings are going to be down. People are spending less. It's going to be a horrible retail Christmas, etc., etc., etc. All the way, most of the way of the days back down. This is essentially a shooting star in technical analysis, this candle that we're looking at here. And it's almost 1,000-point range from its low. The low of that candle is 33,880 and the high here is 34,880. So, you're talking about 1,000-point range on a shooting star. That's quite high volatility. The bigger the move up and the bigger the rejection, the more significant as a possible localized high. So if we look at this, we also see it's a broadening structure, which is on what we call a bull pole. So if I were to draw a line, what has it been? It's been a rally to the upside. That is a bullish pole. Let's make it a bit darker and a bit bolder. And that is an upward leaning megaphone. If you go to themarketsniper.com, you can find out how we utilize broadening patterns to ascertain whether they are reversals or continuations. You'll learn a lot more and in a much more detail, and you'll be able to utilize these techniques in terms of your technical analysis right here, themarketsniper.com. Book a call, have a chat. prove you semi-sane, and we can go from there. In terms of that area where that broadening structure occurred, it also happens to be the neckline of a head and shoulder that's already performed, that we drew, and it's not the prettiest. We talk and we specialize and we understand complexity in head and shoulders. Another reason why you'll only get this information from us. Go to the website, book a call, and you'll see it here. Very flat, loafing left shoulder, long, low vol, grinding up, a final surge, complexity to the head, and then bang, you are done. Note the armpitting. We call it armpitting 1 and 2. That is real definition. And shrink wrapping, the component that is the shoulder, the head, and then the secondary part. This you can only learn from, you guessed it, themarketsniper.com as part of HVF method, how to utilize head and shoulders properly. Anyway, so that would have been a technical trigger. You've got a broadening structure on there, and then you smashed through the target. This is not the first rally to the neckline, by the way. What happened last time you were here? A deeper dive to the downside. You often get quite vigorous rallies in what has been a bearish market so far for the year. Now you're back at similar levels again. In fact, you've crept marginally higher on there, you were rejected. You crept marginally higher on there, you've been rejected. And now you've just had the most positive good news, which could actually be bad news, and you've been rejected. Markets go down on bullish news. In bear markets, markets blow off and go down on bullish news. You know you're at a bottom when you start to go up, or you stop going down on bearish news and you start to go up, and you know you're at a dangerous localized high when you get bullish news. CPI, we're winning the battle, and the market actually rejects after a period and can't hold on. There's volume analysis that can and should be done here. We will do that inside the premium community. But for keenness and for elements of this particular discussion, what have I mentioned? Big news coming out today, interest rates coming tomorrow, localized high rejections here before, a key level that is always just being run at the 33.6, a broadening structure that is now in play with an ascending angle, which is bearish on the bull pole, a daily shooting star where you had 1,000-point range and were rejected. How many points is that? I haven't even been counting. We must be on number 5. And making a localized high on potentially good news. Oh, dearie me. This does not spell well for the equities. The Dow has been the strongest of the indices. Don't go looking for better news on the SPY or the NASDAQ. You aren't going to get it. And the daily price action is indeed similar. Okay, so there you have it. So we're actually concerned for that. Now, I already have positions that are bearish equities as disclosure to you, and also telling you how I've been trading this. So you might see that as a book bias. I am, however, long precious metals, which I also like. And I like to the bullish side during this environment, but I anticipate in a great demand destroying event that the paper derived market in terms of price could be hit at some point when we have a major demand destroying event. And let me tell you, if you aren't anticipating a derivatives, a repo, or a major credited event, you haven't paid attention to the fact that the federal funds rate is higher than it was in 2019 before the crash of CV19, and we have more debt in the system than we do now. So we've gone higher, carrying a heavier load, and we're on older legs. How do you think that pans out? You should be anticipating, and there are so many risks to the downside, both manufactured and engineered possible events and organic events that will happen of their own accord. So looking at silver, we've been encouraged by the momentum today, but at the same time, there's real structure of a rising wedge in here. Now, it doesn't mean every rising wedge breaks down. This is your first impulse, second impulse. Go ahead and learn about 3 impulse rising wedges. In the HVF method, you will not hear about this theory anywhere else. apart from free on this channel, did you remember to hit the like button and subscribe for getting the best technical analysis knowledge that we can share to help you, even though you haven't paid us a cent, to try and make you a better technical trader. Yes, there's so much more on the other side, but we want to help. We want to help regardless where you are. Anyway, the 3 impulse rising wedge has completed its 3rd impulse. It's always the flattest over there, and you've had a little pop out the top. Now you can continue up, and that would be fantastic for silver. Believe you me, as a long and a stacker, I'm very happy for that to have happened. But potentially you could also get a surprise on the rates news tomorrow, and that could turn out to be what we refer to as a type 2, a pop out the top and a bit of a kicking on the downside. Will the Fed have a surprise, or will 0.5 be deemed too bearish in lieu of today's inflation rate? You're doing enough, you're doing enough. At 0.25 would have been enough, and in they storm 0.5. Maybe that'll be enough to generate that level of price action. So there you have it, our take on what is going down. We've undershot on inflation. This has undermined the strength of the dollar further for now, and the dollar will continue to slip against a number of currencies. By the way, we may as well show you one currency as well, given that this is going to be a nice short form vid for you. Again, we've been warning about a rising wedge on the euro. Again, you've had the pop out the top. You made a key level of significance. You'll find out what that is if you're in our community and what formed it. You've also taken out a legacy downside break that gave you the parity run. I've shown you that before on this channel. Go and watch recent previous videos that gave the parity run that we expected and called on an inverted. You have taken and cleared that funnel level to the upside. This is your euro squeezing. It had a little bit of a squeezy in there that took it out the top of the rising wedge. But has it made a key level, and could this now be softness? Generally, in general conditions where there are no other clear macro elements, remember this is a rally for a currency that has fallen from 118 at our call on the right shoulder of a head and shoulder. Go see previous videos where I demonstrated that, the most recent one as well, all the way through to a parity run. And I think it was 96 at its absolute low, which has been an incredibly profitable trade that we kept you dollar dominant. Now you are actually still in what qualifies as a rally, not necessarily a reversal for the bigger time rate, but you certainly made a localized high for the dollar strength and a localized low here, and you are rallying. But the trend has been dollar dominance. So we will see what happens tomorrow on the rates. If this too could do as per the silver, but my suspicion is the euro has a lot of problems baked in, and I'm not too confident that it's going to be easy weather for it to go back into the 107s. However, if it does, it would indicate that you're going to have a more sustained than expected dollar weakness cycle. So there you have it. For now, dollar weak on the currencies versus the euro. They are a little bit of a binary pair. What's good for the dollar is often bad for the euro, seesaw, and what's bad for the euro is good for the dollar. So they tend to have a bit of a binary relationship in the Western hemisphere, but nonetheless you would have also seen a little bit of strength for the pound coming in against the dollar and other currencies as well. Okay, that's it. Remember, you can find out more about what it is we do, how we do it in HVF method trading, how you can make money in the massive falls that we see is coming. All the risks for me are to the downside. I know there are a lot of bears out there. That doesn't mean they're all wrong. We have unbelievably high rates on an immense amount of debt. We are still expecting some form of tightening tomorrow, and the system just doesn't have that degree of robustness. And unfortunately, in these inflationary times, whilst inflation is generally supportive for the stock market, when you get hyper stagflation, which is the killing of growth, the killing of the retail consumer, due to stagnation in disposable income versus the inflation, stagnation in salary increases versus the inflation in real terms, increases and stubborn increases in costs that won't go away given reduced supply chain. That is a throttling of the neck that stops the blood going to the head. That's right, you get what I mean. And that means it's very hard for, once the early fluff in the inflation number has been reduced, it's very hard to drop lower because the supply chain is now far smaller and the options greatly reduced for key things like energies, gas, petrol, fuels, etc., etc. Never mind the engineered shortages and the reduction of farms, for example, due to fertilizer and all this badness causing a green emergency. It does feel like a throttling in the volume and supply and scarcity, attempted to create scarcity in the food chain. Anyway, we don't want to go full reset on you. Thank you for watching. Hit the like, hit the subscribe. Don't forget to miss the bell. Book a call if you're interested to learn more about HVF method. I am calling localized high on the Dow. I am wary on the euro as to expect it to continue too much further, although there might be a slight bit more to the downside. That is not a strong call, but I would say the silver also looks like it's not the ideal time for entry. If you're a stacker, you can accumulate and buy after a dip. I would still expect the paper price to come down once the demand destroying events come. Everybody will be rushing to create liquidity and will be caught short, and that is a sell regardless. Until next time, I thank you and I say goodbye.